Hello students and welcome to Legacy IAS Academy. In this lecture, we'll be looking at the SEBI rules that have been brought out to curb the F&O volatility, the futures and options. These are the derivatives. So for reducing the volatility in this derivative market, SEBI has come up with certain rules. So we will see what those rules are, what implications they have and what impact they are going to have. So let's get started. So what's the news? As I mentioned, SEBI. SEBI is what? The regulatory body. Okay, it's the Securities and Exchange Board of India, which regulates the security market in India. It has introduced certain significant reforms in the equity index, in the derivative instruments. And the major focus of these reforms is to curb the volatility that is there. So, curb the volatility, and by curbing the volatility, they are trying to specifically safeguard retail investors. See, who are retail, small, in fact, you can say small retail investors. So, who are retail investors? And individual investing, generally they invest very small amounts. So, the small retail investors needs to be protected, and they can be protected when SEBI addresses the volatility issue. So, they have come up with certain reforms which will curb that and help the retail investors. Now, why volatility would specifically help them? See, this volatility can help others also, but why specifically focus towards them is retail investors. They, we will invest for short term. For example, we may invest small amounts, and the amount will be so small that when fluctuation is there, a retail investor is not an institution or a knowledgeable or someone who's certified, has the exact knowledge, but this is just putting our savings into that. And because of the volatility, this retail investor may get scared and get out their money and make all the losses. Whereas when you look at the institutional investors, they know if this is going down, it is going to come. They play the long game. In fact, when through mutual funds you invest, ask the mutual fund experts to do it for you. A lot of time it is so happening that you are into the negative. It's just that you don't know it. So individual investors generally plays with their own emotions, they take the better of them, at the same time the amount are small, so the volatility is going to affect them even more. And to address that, to safeguard them, SEBI has come up with certain reforms. Let us see what these reforms are and what are their implications and impact. So first is recalibration of the contract size for index derivatives. Now, what is this all about? So the minimum contract size earlier was 5 to 10 lakhs. Now it has been increased to 15 lakhs. So you can see minimum contract size for index derivatives increased to 15 lakhs from the earlier 5 to 10 lakhs effective 20th November 2024. So just in 1.5 months this is going to be effective. Having said that, what does this do? Earlier it was lesser, now it is more, so now it will attract more serious players into the market and not just the people who are going by the sentiment and creating volatility in the market. So this creates an entry barrier. Okay, this creates an entry barrier. Now this is what the implication is, raises the entry barrier, ensures that participants have sufficient risk tolerance. Because you are ready to put higher amount of money means you have higher risk tolerance. Okay, so it will discourage small traders from taking excessive risks. Okay, now if I do not have that much of money, then I may not be taking the risk. The flip side of that, however, is, which is also possible, but then that's, you cannot control everything. The flip side is, let's say I was borrowing some money and putting in the market. Earlier I was required to borrow only 5 lakh, now I am required to borrow 15 lakhs. So that may become even worse. That is there, but you cannot control everything. There will still be certain exceptions which, may not be addressed. But generally this is the case, that you create a higher threshold so that people with higher risk capacity will enter it, and that will ensure that small traders do not take the excessive risks. Then upfront collection for options premium. So from next year, that's for 1st February 2025 onwards, the trading members must collect the options premium upfront from the buyers. Trading members means when you are basically when you are, let's say, buying. Okay, what are options? Options are, you let's say buy it today, you give the money today, but you will get the underlying asset later on. Okay, so that is the contract. So I make the contract on 1st Jan, let's say 1st Jan 2024, and the contract will be executed, let's say, on 1st June 2024. Now this contract will be with respect to some money being given, some underlying asset being bought, right? But if we have zero money involved over here, there will be no obligation at all. So for some amount of obligation or a commitment to be shown, there is a premium which has to be paid, right? Now that premium needs to be collected upfront is what SEBI is saying. Earlier that was not the case. Earlier, when that was not the case, some platforms were still collecting it upfront, but they were not obliged or forced or compulsed to do that. Now it will be compulsory to do that. I hope that is absolutely clear. When you do that, it of course reduces the misuse of leverage. Take this for example. You know, you go to purchase an asset or something, and you do the down payment, or you do the, not the down payment, actually the token amount. When the token amount is there, then the person will hold that property for you, because this token amount is showing your seriousness. Without giving any token amount, no one will hold anything for you. So it is exactly what the premium does over here. So it reduces the misuse. It will reduce the misuse, or else every now and then people will come say, yes, I will buy, give me 6 months or 1 month without any token money. It's not going to happen. So that is the impact, that is the implication of it. It will protect the investors from over-leveraged positions. Over-leveraged position, because your money, the buyer's money, will also be, to some extent, the premium amount will be invested. Then you have rationalization of weekly expiring derivative products. So it is a very simple reform which has come in. Earlier there were few of the indices wherein there was weekly expiration derivative. Now SEBI has reduced it to only one benchmark index. So if you want weekly expiring derivatives, you cannot have it linked with various indices, but you can have it linked with only one benchmark index. Because of it, what happens? It limits the frequent speculative trades. If you have more and more indices linked, more and more speculation would be there. If you link it to just one, it reduces the number, the quantum, as well as the frequency of the speculative trade. And when speculation reduces, what will happen? The speculative pressure, indirectly the volatility will be reduced. When volatility is reduced, what will happen? Stability will increase. That is the impact of this. Further, intraday trading monitoring, or intraday monitoring of position limits. So presently what happens is, intraday monitoring is still there, but the monitoring happens at the opening and at the closing, right? But now the monitoring is not just going to happen at the opening, at the closing, but also in between few times in between also. Now why is this? Very simple. Let's say I have been given a task, I have been given a task for 2 days. So today I have been given a task, I have to complete by tomorrow evening. Now if the person who has given me the task directly checks it tomorrow evening, they may get to know whether I have completed or not. If I have completed, all right. If I haven't completed, then what? They do not have any time to correct it. They do not have any time to now get it done within time. So the better thing to be is not just to check at the end of the day, but check during the day also. If let's say a task is of 1 day, I was given yesterday night to do a task today. So in the morning it will be checked whether I am on it or not. And if you just check at the end, I may not have completed and you will not be able to do anything about it. So you keep checking in between also as to what is the status, so that you know how much volatility is there or not. So earlier it was just during opening and closing. Now it will be there in between as well. That will start from 1st April 2025. Okay. So it prevents excessive speculative position from being built up, because SEBI is keeping an eye every now and then. Real-time compliance will be ensured and it will be more smooth. Further, removal of calendar spread treatment on expiry date. Now this is a very interesting thing. What is a calendar spread? See, there can be one particular derivative and I can have that derivative for short term as well as long term. The same derivative for short term and long term. The short term might be maturing today and the long term later on. So my long term investment in the same derivative may hedge any volatility which will be there in my short term investment of the same derivative. One important thing here is, what is the calendar spread? What happens is, if I would have just invested for a short term, on the day of the expiry, I need to have some amount additionally kept with me for ensuring as a buffer for any risk that might be there. So if I am investing, let's say 1 lakh rupees, some X amount of rupees, let's say 1 lakh is the risk mitigation money I should have. Now, since I also have a long term investment in the same derivative, let's say of 1 lakh rupees only, this 1 lakh rupees used to act as the buffer for this. And this advantage, without having any additional money, this long-term investment used to act as a buffer. Because the expiry date of long-term one has not yet come. When it comes for that, then I would need money for it additionally. But right now, the investment here itself is acting as a buffer for my short-term investment in the same derivative. And this advantage which I am getting was known as the calendar spread. It is happening because of the different dates, the calendar spread. Now SEBI said that this will not be the case. Your long-term investment in the same derivative will not be considered as the risk mitigating money which is required. It needs to be separately present. And that is what is from effective 1st February 2025, the calendar spread benefits will not be available on the day of contract expiry. So it will make the system more resilient. I hope that is absolutely clear. The next reform that is there, it's related to the tail risk coverage on the expiry day. So what is the reform here? An additional extreme loss margin of 2% will be levied on the short-term options contracts on the expiry day. Now what is the significance of this with respect to the expiry day? See, on expiry day what happens is, there is a very high frequency of trade that happens on the expiry date, which causes a very high level of volatility. Now to be able to address this volatility, an additional 2% of extreme loss margin will be levied on the short options contract on the expiry date. When this is levied, what will happen? It will provide an extra protection or greater protection against extreme market movements. And these extreme market movements generally happen on the expiry date. Think of it like this, wherein the budget allocation is there for a particular year, and if that budget is not going to carry forward, in the last months the ministries will start spending left, right, center, because anyhow if the budget is not getting carried forward, it will start spending. So frequency of expenditure will be very high in the last month. In the same manner, the frequency of trade will be very high on the expiry date, which will lead to extreme market movements, and it can move anywhere, and whether it's moving up and down, it is going to impact negatively to someone or the other. So to address that, additional 2% will be there, so it will reduce the risk of significant losses. Why? Because of this rare market events because it is happening only on the expiry date specifically. Okay, so it will also improve the market resilience. Now after these reforms are implemented, because there are different dates of implementation, November 2024, February 2025, April 2025. So when they are implemented, how are these reforms going to impact India or Indian securities market? First thing is curbing speculation. We have seen speculative tendency would be reduced. It would curb that. The market wants, SEBI wants that you play on the fact how good or bad the company is doing. Right? Just by speculation, it eats up a lot of money. It shows you the inflated data. Of course, some part of speculation would still be there, but huge volatility which hampers the small retail investors should not be there. And of course, it will lead to better market stability. Further, protection of retail investors. The above two things which we saw is specifically for protecting the retail investors. Of course, it will protect other investors also, but it is in focus with respect to the small retail investors. And because of that, it will be promoting capital growth, because the money would not be lost because of the speculative tendency. It would rather help in capital formation and capital growth. So these are the various reforms brought in by SEBI and what they are and how they are going to impact. So factually, you should know all those things for your prelims, and there can be a mains question as well. So implications becomes really important for that as well. Thank you.